And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
Good morning and welcome to the show. Of course, it is Tuesday. It's also Two Deads on Money, talking today a little bit about kind of a year-end checklist for investors and also some other kind of topics around just financial management. Get ready to wrap up the year. There was a very interesting analysis out the other day, and I posted this on Twitter, X. In 50 years, I will get it right. But I posted this analysis out, and it showed wealth by brackets, by quintiles, right? And what it was interesting about this is it shows that, we talk a lot about the wealth gap, and what's interesting is that when you look at this analysis, kind of the bottom 50% of the economy, the bottom 5 quintiles, all their net worth is in their house. Now, if you start looking at the upper quintiles, this is where we talk about the wealth gap, most of their wealth is in investable assets or businesses, right? So they're investing capital, making that capital work versus being tied up in an ongoing expense. And this is one of the big myths about home ownership. We drive a lot of young people as we say, oh, you need to be able to buy a house. And of course, lots of headlines about housing unaffordability. It's so unfair, I can't afford a house. Don't worry about buying a house. A house is an expense. It's not an asset. It doesn't grow wealth, because even if your house appreciates in price and you sell it, that's great. You've got to go buy another house to live in. So you don't really create wealth through housing unless you're doing, buying rental properties, those type of things. We're talking about primary residences. So if you really want to work on building your wealth, focus on investing assets, building a business, those type of things that create income and create wealth over time. And again, look, there's a lot of money to be made investing in real estate, but that's on the investment side. So again, we're talking about, people that have their entire net worth tied up into their primary residence, right? So, it was kind of a very interesting analysis. I'll try to show you that chart here in a few minutes if I can find it for you. But outside of that, it's also very important today to note that today is let me rephrase that. Today is very important because it's anything covered in chocolate day. Oh. So that's right. You know what John, what do you think the number one thing dipped in chocolate is?
First thing that came to my mind is strawberries.
Alaska. Brent, you got to pick. Number one thing dipped in chocolate. That's not the right answer.
Peanuts.
Peanuts. Nope. That's Georgia Southwest. No.
Okay.
Number one thing dipped in chocolate. Bacon.
What?
I wouldn't have been close. Nope.
Bacon. It's sweet, savory. It's the number one thing that people like dipped in. I thought it'd be like pecans here in Texas, right?
Yeah,
we're famous for pecans, but it's not. Cherries is up in like Maine, not in Michigan. Yeah. So, but bacon, mostly Midwest. But number one thing dipped in chocolate, bacon.
I shall have to try it.
It's sweet and savory, I guess, right?
Yeah,
so, anyway, go dip something in chocolate today. That's the real thing, or just eat the chocolate. So.
Put some peanut butter on it.
There you go, peanut butter on it, yes. All right, let's talk a little about what you need to know before the bell this morning. We have a slate of economic news coming out today that is going to be moving the markets. We're finally starting to get some of the data after the government shutdown. So today we've got payrolls, retail sales, just a whole lot of data. So markets are a little tentative this morning, pre-market open. So again, a little bit of sloppy open this morning. Wouldn't be surprising if the numbers come in better than expected. We could see this market rally a bit on expectations for further rate cuts, those type of things. So again, lots of data today that's going to be moving the markets. We'll kind of cover what a lot of that looks like tomorrow when we actually get the data to work with. But that is going to be moving markets this morning. But as I said, markets are opening a little bit weak this morning. Now, yesterday, markets opened up decently, right? And we talked about this yesterday morning that, we had a little correction on Friday. Markets were going to open up, and we did. We opened up nicely and then kind of immediately sold off and kind of finished around flatline yesterday. Markets really just traded sideways most of the day yesterday. But as we talked about yesterday in particular, is that we could come down here and test this 50 to 20-day moving average, kind of connection that we have going on right now. Markets are very close to triggering a sell signal. That's not the end of the world. We've seen these before. They can kind of flip back and forth a bit, but it does suggest some near-term weakness in the markets, and we're still working off some of that overbought relative strength that we saw last week. So again, the market's still just working within this consolidation range in general. Nothing to be overly concerned about, but again, people are starting to question already. It's like, well, maybe we might not get a Santa Claus rally this year. Hey, it's possible, right? As we've talked about previously, yesterday typically starts the beginning of the seasonally strong period. Markets are up on average about 1.4%. As we said yesterday, that doesn't mean it has to happen. That's the average, which means that over time, sometimes it's larger, sometimes it's smaller. And right now, we may be looking at a little bit weaker trend right now until we kind of get some of these positionings reset. Again, we're kind of at the top of this trading range, working this consolidation range. So again, a bit of a retracement here is not going to be uncommon. Doesn't mean you're not going to get a Santa Claus rally. It just may be closer to the end of the year than starting right now. So again, there's nothing to be overly concerned about. Nothing's falling apart in the markets. We're not seeing a big uptick in volatility by any stretch of the imagination. But we are seeing, we're seeing kind of volatility base here a bit, and so that certainly suggests that potentially we could see an uptick in volatility and a bit of a sell-off in the markets, and that would kind of correspond with a buy signal on the VIX. So, there's certainly some reasons right now to be a little bit cautious here over the next week or so. But again, historically speaking, on average, you continue to get this kind of push into year-end, window dressing, those type of things. But one of the things is we've had a very big rally this year, so we may see some more kind of weakness here over the next few days until kind of portfolio managers get reset, do their tax loss harvesting, the things that they need to do for end of year positioning before they start reallocating to their book. So again, we may see a rally, but it might be later this year. But again, there's no guarantee of anything happening. So don't bet all of your eggs on, basically a rally into year end, because that doesn't necessarily mean it has to happen. So manage your risk, manage your exposures. Very good article out this morning talking about relative returns over time. And if you want the highest rate of returns with the least amount of risk, buy dividend yielding boring stocks. They provide a higher risk adjusted rate of return relative to growth stocks, tech stocks, all that over time on a relative basis, because what that means is that you're avoiding those big major drawdowns in markets when they occur. So, again, it's important to balance risk and manage that in the portfolios so you can control and survive the long-term aspect of the game. Anyway, that's what you need to know before the bell this morning. When we come back, we'll pick up with Two Dads on Money. Don't go away.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
What's the future of investing in 2026? Gain insights on how AI, technology, and the economy will shape your money in the year ahead at the RIA Economic Summit, January 17th at the Royal Sonesta Houston Galleria. Join Lance Roberts, Michael Leibowitz, and Thoughtful Money's Adam Taggart, plus top minds in AI, crypto, and retirement strategy for a powerful look at the markets of tomorrow. Seats are limited. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
Good morning and welcome to Two Dads on Money. Of course, it is getting ready to wrap up the year, and there's some important things that are going on right now, especially if you're a younger employer just kind of getting out, younger employee, just getting out into the workforce. There's a lot of things that you need to make sure you're taking care of at work so you don't wind up kind of blindsided. One of those things right now is that we are in open enrollment for your benefits at work. So if you work at an employer who provides you health care, dental, vision, those type of things, it sounds great. And I was just actually talking to my son yesterday about this as well, because he was like, I didn't know anything about this, right? And a lot of people don't. We just kind of assume it's like, when you go get the job, they say, oh yeah, we the salary's this, and we provide 401k plan, and we provide benefits. You go, great. And you go home, and he's like, Mom, I got this job, and it's awesome. I'm going to get health care. I'm going to get all this great stuff. You have to apply for these things, right? So it's not just going to show up and magically be there for you. You've got to set up your 401k contributions. You've got to make your allocations, and this is the time to do this as we're going into year end. And also, this is where, importantly, you've got a very narrow window to select your health care benefits for the next year. And if you don't apply for them, you won't have them.
That's right.
Right?
Yeah. It just doesn't happen automatically. So take the time. You're either in open enrollment, you're about to wrap that up, right? Just does it make are there things in your I almost said arsenal, but that's in your arsenal of health benefits through your employer that you need to take advantage of, right? Even simple things like a health savings account. Do you have the ability to participate with a high deductible health plan, right? If you have a FSA, know the difference between a flexible spending account and a health savings account. Because with an FSA, if you have money in there, let's say you've already contributed or put dollars into a flexible spending account, if you don't use that money by the end of the year, you forfeit it, it's gone, right? Unlike a HSA that you get to grow that wealth over time. It's almost like a Roth IRA for medical expenses. With a health savings account, you get a triple tax benefit. Remember, money goes in, you get that deduction. When the money goes in the health savings account, that money can grow tax-free, especially if that money comes out later down the road for qualified medical expenses. All that money comes out tax-free. So as you get in there and look at all of the options that you have for your open enrollment, if you have questions about this stuff along the way, reach out or talk with your benefits department. Just make sure that you're taking advantage of everything that is available to you. There are many folks this year that I have found through their employer benefits, you have the ability to almost pay a little bit of a small copay to have the ability to use a network of various other financial professionals like estate planning attorneys. I cannot tell you how many conversations I'm having with folks this year where even younger investors, it makes sense to have a will. Make sure you set up your powers of attorney, durable powers of attorney, your medical powers of attorney, your advanced directives. I know this is all the fun stuff that we're talking about, right? But if you have the ability to use an attorney through your network, through your employer benefits, chances are that's going to be at a much better price point versus just going out and hiring an attorney on your own. So take a look at that too, just to see if it makes sense, right?
Well, no, and again, it's just generally you'll get an email, and this is where the mistakes happen for a lot of individuals, because you get this email, and it's this email from your company, and you just kind of, oh yeah, I'll get to that later, and then time just slips by, and you don't realize that open enrollment's going to close. And there's so many things to really pay attention to. Again, an HSA, if you have access to not every company gives you an access to an HSA, but they are wonderful things because, again, like John said, you contribute, after tax, pre-tax, so no tax on that money that goes in. It grows tax-free, and you don't have to take it out. My wife has access to an HSA. We don't through our company, but she does. Right. And so she contributes as much as she can. We never intend to use that HSA. If we have a medical expense, we just pay for it out of pocket, and she has a high deductible plan. So yeah, you've got a couple of $1,000s you've got to cover before insurance kicks in. But we're just letting that HSA grow. And at some point down the road, in 15, 20 years, whatever, there's going to be another pot of money there to help pay for healthcare bills later in retirement. So it's an absolutely wonderful thing that you can have access to. But again, we talked about healthcare before. One of the problems with the healthcare system, and the one reason why healthcare is so high, is that people go every time they get the sniffle, right? They run down to the doctor because I've only got a $25 copay. That's great, but that expense is getting picked up through insurance companies, which is that's what elevates the cost of insurance. Go for the high deductible plan. Yes, you're going to have to pay that deductible, but do the maintenance on your own, right? Work out, exercise, eat right, do things to not get sick so you don't have to go pay the deductible. And that's really just one of those things. It's more like car insurance. And when you buy car insurance, you just buy, I'm just going to buy accidental coverage and liability, right? I'm just going to pay for the cheapest amount. I'm just going to get liability coverage. And the game you run with that is like, yeah, I've got a very low insurance cost, but what happens if I cause somebody else an accident, right? Or they cause me an accident? Then all of a sudden I have to cover all this stuff out of pocket. So a high deductible plan is like car insurance, right? Just buy the max coverage that you need, have that limit in there. So yeah, you're gonna have to save up some money to cover that deductible at some point down the road, but hopefully you don't have to use it, and then be saving into that HSA to cover that deductible just in case something catastrophic happens. You're playing a little bit of the odds game, but again, typically you can save money and work out a better plan over time and lower your healthcare premiums you're paying out of pocket every year by using a higher deductible plan.
Absolutely, and you start putting money into the health savings account, you can invest it. Once the dollars go in there, you're not really, I've seen several HSAs where you're not limited to just like a menu of different mutual funds, like within a 401k plan. So you've got kind of free reign on where you can invest in there to a certain degree, right? So there's a lot of flexibility when you put the money into the health savings account, like Lance mentioned. Let that money grow and really work for you, so that way later down the road, that's when you can really use it to help look at supporting your healthcare needs as you get a little bit older, right? But I think sometimes there's a little bit of confusion around when do contributions for a health savings account for 2025, as example, need to be made, because we're coming up here in the last 2 weeks of the year. You actually have up until April 15th of next year to get money into a health savings account for 2025, right? And that's the same thing with Roth IRAs, traditional IRAs. To make a contribution for 2025, you actually have up until April 15th of next year, right? Now, if you are wanting to make a conversion to a Roth for 2025, the conversion to your Roth IRA needs to be done by December 31st of this year. So a Roth conversion, if you're looking to do that for this year, it has to be done within the next 2 weeks. A contribution to a Roth, that's different, that has to be done by April 15th of next year. Now, there are a lot of times where I'm visiting with folks and you make a contribution to a Roth IRA and then you later found out that you weren't eligible. That's okay. You can recharacterize your Roth IRA contribution to a traditional IRA by your tax filing deadline. That's okay. But just remember, Roth conversions have different rules. So when you convert money to a Roth from a traditional IRA, that is irreversible. So whenever you make that conversion, so many times before you make that conversion to a Roth IRA, just make sure you're really taking into consideration all your different sources of income this year. Dividends, interest, capital gains, whatever that might be, all of your wages, your income, and see where you fall within your bracket. So, but then after you make that contribution, after you make the conversion to the Roth, it's irreversible. So just some things to think about there, right? But going back to some of the other end of year kind of checklists for if you're a little bit of a younger investor, maybe you're kind of getting started, looking at open enrollment, looking at your retirement plan through your employer, 401k plan, 403b. Hey, if you're fortunate where your employer gives you a match on your contributions, in my mind, that is free money.
No, it is free money.
Don't walk away from it, right?
Yeah.
Make sure, so if your employer says, hey, we will match you on the first, dollar for dollar on the first 3% of your contribution, or they'll match you on 50% up to the first 6, whatever the match is, make sure you are putting in the contribution to get the full match from your employer. Just don't walk away from free money, okay? Something else to really pay attention to.
Go ahead. Before you jump off 401ks, because I see this all the time, especially with younger people, in particular with their 401k plan at work. You need to do a little bit of math homework. I know nobody likes math homework, but you need to do a little bit of math homework. Here's one of the common statements I get from young people. It's like, I can't afford to contribute to my 401k plan because of this reason or that reason or whatever, right? Because what they're working off of is what they're bringing home, right? So I make $1,000 a month, and I bring home $800 after I pay all my taxes, my FICA, my FUTA, my all the other stuff I got to pay. I wind up with $800. And so that's what I'm having to live on, for the month. And I get that. I certainly understand that. And so they bypass contributing to a 401k, 401k plan. And this is evidence in the statistics, right? I mean, 50% of people don't have access to a 401k, 50% of people that do, only 50% of those people actually contribute. So, people are passing up free money. And so here's some of the common mistakes that I see. So first of all, it's just a 3% match, it's no big deal. It's a big deal because, again, like John said, somebody's giving you money. This is one of the benefits that the company gives you for working that's above your salary. So you're getting a salary, but they're also giving you money contributed to your 401k plan. The other thing I hear is like, they don't match, so I'm not going to contribute to my 401k plan. Why? Because that's money that you can contribute and reduce your taxable income. One thing John talks about a lot is he says, you should contribute to a Roth 401k. If you have access, contribute to the Roth 401k. Right. We don't disagree on that, but hear me out. Hear me out.
Okay.
Just hear me out for a second. If you're just getting started out and you're having trouble contributing, right? So think about at least consider the pre-tax 401k side, because again, I can contribute money to that I don't get taxed on right now. So I can literally contribute to my 401k plan and bring home about the same amount of money I was bringing home before because I'm not getting taxed on that money that I'm putting into the 401k plan. So you can at least start getting towards your match, right? And again, I know he's probably rolling his eyes over here going, but I'm just trying to, what my point is that don't bypass contributing to that retirement plan at work, right? Just because of money, and it tells you if you can't also too, there's a big message here. If you can't contribute at least the minimum to get the match, you need to work on your budget at home,
Absolutely.
Right? There's the other caveat to this. But you should focus on, I see a lot of young investors, they make this mistake, and it is a mistake. You may not think it's a mistake right now because we've been in a bull market for the last several years and it's like nothing ever goes down, it's always great. A lot of young investors, they bypass the 401k plan because I want to invest in crypto and all this other stuff. I want to take these high risk bets over here. That's fine, but you should do that after you're maxing out how much you contribute to your 401k every year. That should be your first goal. And this is where I also get a lot of emails from people like, I don't like my choices in my 401k plan. You don't need a bunch of choices in your 401k plan. An S&P index is just fine. That's all you really need. And there, you don't need this whole big menu of options. Most people don't understand half the options in their 401k anyway. Find an S&P 500 index and contribute to that every single month and do the max you can every year. And then once you're maxing out your 401k, awesome, now start your investment accounts outside of that and start building your after tax where you can take more speculative risk. But be conservative inside your 401k plan. Take advantage of that match, let it grow either tax-free or tax-deferred depending on what plan you have. But don't bypass that. That's a huge, most of the people that I meet with, the vast majority of their wealth is in their 401k plan because they've just been contributing to it for 30 years and it's been growing over time to retirement. Their other investment accounts are not that big. Why? Because they lose their butt all the time in the markets, right? But that 401k plan, they're just dollar cost averaging into it and it grows over time. Use that benefit that it has available to you. Don't ignore that. I think it's one of the most overlooked financial wealth building tools by young investors of everything that's out there.
Yeah, just start with your 401, or maybe it's a 403b, depending on the nature of your employer, right? Just start. Yeah, and a lot of everything, a lot of the points that Lance just made, I see that too, where especially as folks get longer in their investment career, typically the bulk of their net worth is in their employer retirement plan, because to Lance's point, you set it up at an early age and it's almost on autopilot at that point, right? And through your open enrollment, you should be able to designate, hey, every year increase my contribution to my 401k plan by X%, and you don't miss it, right? And especially if as you're going into, you're wrapping up 2025 and you're getting into 2026, what if you're fortunate enough to get a pay raise? Hey, take some of that pay raise and automatically increase the contribution to your 401k. You won't miss it, right? So just set that on autopilot, because that regular contribution that happens over time, it helps you take the emotions out of investing. So you've got this money going into the 401k plan or your 403b, whatever that is, on a regular basis. And guess what? If markets are a little bit higher, you're just going to buy a little less shares. If markets can come down in value, guess what? Stocks are on sale. You're going to buy a little bit more. And to Lance's point, if you're not fully educated or aware on what the investment options are within your 401k plan, because I see this a lot, where I'll get, hey John, here are the list of options that I can use in my 401k plan. I really don't understand what these are and what they're designed to do. Hey, make 2026 the year where you set a little time aside for yourself and educate yourself on what are the investment options available to you within your 401k plan. How do they work? And to Lance's point, you can keep this very simple, very straightforward, especially if you're a younger investor. In there, find, and typically I've seen just about every 401k plan has some variation of a Standard & Poor's 500 index fund. Find it. If for some reason you can't find it or you're just having a hard time figuring out what's in your 401k plan, hey, reach out to me. I'll look at it with you. Happy to do it, right? But yeah, don't forgo the match. And even if you don't get a match, contribute to your 401k plan. Hey, if you're a younger investor, let's say based upon your income, if your earned income is too high, that does not allow you to contribute to a Roth IRA. I know Lance was talking a little bit about the pre-tax help within 401k plans. There are a lot of folks that I work with where they need a little pre-tax help right now. I get it. But I can also build an argument where even if you're a younger investor and your income is too high, you're not eligible to make a contribution to a Roth IRA. There's no income limit on making a contribution to a Roth 401k. So those are things that we can look at. Even if you don't get a match, that allows you to get after-tax money into your employer retirement plan. So that way when you retire or you step away from that business, who knows, 5, 10, 15, 20, 30 years from now, you've got a big pot of after-tax dollars that then you can move to a Roth IRA, and that can continue to grow tax-free. And all these phone calls I'm making right now to tell people to take out their required minimum distributions from their traditional IRAs, you won't hear from me about that because Roth IRAs don't have an RMD. So those are things that you can set this up at an early age to benefit you later down the road, right?
Absolutely. No, and look, these are all just things that, it's like, and again, one thing too is there was a comment in here about tracking down an old 401k. Absolutely. I see a lot of people, they shift jobs over time and they've got 401ks at 5 different companies, right? Because they've transferred jobs. Go get those and roll them over into your new 401k.
Yeah.
Right? So, and again, where a lot of people make a mistake is like, I'm going to take this, put it in this IRA so I can go trade it. And that's great. You trade it and you lose it and you've destroyed the whole reason why that was a retirement account. Roll that in your 401k. Keep those consolidated because now you're still contributing to it, but you're contributing to a larger balance of that and it helps it grow over time. So, go out and track down those 401ks. And plus, if you've got 5 different 401ks sitting at different accounts, you're probably not paying attention to them as much as you should. You don't have your allocations right. You're not paying attention to the risk you're taking. So yeah, get those put together. Manage that portfolio. Consolidation of your accounts is one of the most significant tools to increasing your performance rate over time because you have a much better picture of how much risk you have, what your concentration risk looks like, those type of things. If you start having multiple accounts all over the place because you're chasing different strategies or whatever it is, your actual, and studies prove this, that your actual performance returns over time start to drop fairly markedly because you're taking on concentration risk, you've got diversification risk, but you're not paying attention to them. You don't really understand what your allocation is. You don't understand where your attributions are coming from. All those type of things. So consolidate. Keep your accounts as few as possible and you'll actually perform better over time.
Yeah, I agree. And especially if you have, it's like you start collecting all of these accounts are like Beanie Babies. If any of you out there know what Beanie Babies are, right? I might be dating myself. But let's say you've got 4 or 5 different previous 401k plans hanging out there somewhere. Chances are that's when I also see simple things like beneficiary designations get missed. Right, so always just make sure as you're like in open enrollment right now, when you're going through and you're looking at, hey, should I take my short-term disability? Should I elect for that? Yes. Long-term disability? Yes. You should elect for that too. Make sure that you are designating your beneficiaries on your existing retirement plan that you're making contributions to. And if you have any kind of old 401k plans laying around out there that, look, there are times where I see where folks do keep some money in a previous 401k plan because they're really happy with the investment choices that are in there. Okay, but just make sure you have beneficiaries designated on that, all right? Something else, younger investors. Well, and this could apply almost to anybody at any age, but specifically younger investors. Understand what is your vesting schedule when it comes to the contributions and not so the money that's going into your employer retirement plan. Understand what is your vesting schedule there. Typically, the money that you put in, the money that you defer, the money that you contribute as an employee, you are 100% vested in that money immediately, meaning it's yours. And if you decide to leave that employer, go work for somebody else, you can take that money with you. You need to pay attention to that employer match that we were talking about earlier. Sometimes that employer match, the match goes into your account, but you won't vest maybe for 3 years. That's very common, where those dollars do not fully vest for you until you've been with the employer for maybe 3 years. So there have been several times where I'm helping younger investors, they decide to change employers. They're going from employer A over to employer B, and they're rolling those dollars from their previous employer's plan into their new plan, or maybe they're wanting to roll that money to an IRA, and they're expecting to get, I'm going to make this up, $30,000, but they're only vested in 20. They're like, John, what gives? I'm like, well, let's take a look at your vesting schedule. In order for you to get that employer match, you've got to be with a company for at least 3 years. So just pay attention to that. I see that gets overlooked from time to time.
Yeah, absolutely.
So, but look, this is just kind of simple year-end stuff to be paying attention to as we get ready to wrap up the year. And again, these are things you need, again, whether it's making sure you're getting into open enrollment,
right,
getting your 401k allocations, checked right now. This is a good time to go review your allocations going into next year. Make sure you're contributing enough. Again, and again, there's, the limits for 401ks are changing. So next year, you'll be able to contribute more to your 401k. So now you need to go into your employee portal, probably at your company, and adjust your deductions and your contributions that are going into your 401k and where they're going. So again, this is where a lot of people will get signed up into the 401k and they don't make choices, so they get immediately slammed into a target date fund, which isn't the best alternative. I mean, they're not terrible, but there's some issues with target date funds that affect performance over time. So make sure that you're making sure that your contributions that you're making your 401k plan are going to the right funds that you want them to go to in the right amount. So, build your allocation model. Adjust how much you're contributing to your 401k plan for the up limits next year. John, you can correct me on the numbers here because I don't have them right off the top of my head, but if you're over the age of 50, there's a catch-up.
Correct.
And there's now an additional catch-up up to $11,250, if the number's right, because of the Secure Act. So now, if you're over the age of 50, not only can you do the $23,500 a year into your 401k plan, there's an additional $11,000 you can put in, so you can get up to around $32,000-ish, give or take on the numbers, into your 401k plan. That's money you're not paying tax on if you're going pre-tax, and or is going to go tax-free if you're after tax. But still, that's a good bit of savings you can do.
Yeah, if you're over, as I say, if you're at least 50 years young or over, next year, that's an additional $8,000 that you can put above and beyond just the normal amount that you can defer next year, which is it's gonna raise from, let's see, this year in 2025 it's $23,500 for 2026. That'll increase to $24,500. And to Lance's point, there's a super catch-up if you're between 60 and 63.
There you go.
Then you can put that additional $11,250 in there. So that plan through your employer, that can be a wonderful tool to really put some wealth aside for your future, right? So just have a good understanding of how that works. And if you need help with it, reach out. That's what we're here for.
Yep, absolutely.
Yeah.
So, all right, what else?
Well, so I would also say, I know I was harping a little bit earlier on the estate planning piece, and that was a real fun topic to get into, right? But so many of you that I visit with, I hear, hey John, that's something I'm going to get to next year. Hey, that's something I'm going to get to next year. Or hey, that's something. Or I'll visit with a couple. Maybe they are in their 60s, early 60s, mid 60s, late 60s, early 70s. I'm like, hey, tell me a little bit about what sort of estate planning have you put in place? And typically, both spouses kind of turn and look at each other, then they look at me with kind of the deer in the headlights. I'm like, okay, let's make 2026 the year to get this done. Even if you're a younger investor, I know I touched on this briefly just a little while ago. If you're a younger investor, hey, it makes sense to have a will. Make sure that your beneficiary designations are set up. Have just the basic ancillary estate planning documents in place, a durable power of attorney. Heaven forbid, if something were to happen to you and you're alive, but let's say you're incapacitated, you're not able to make a decision. Again, this is really fun stuff that we're talking about. Make sure that you have a durable power of attorney set up for you that can make financial decisions for you. Same thing with your medical power of attorney for medical decisions. So many of you that I visit with, I hear every time I visit with you, hey, I'll get to it next year, I'll get to it next year. Let's make 2026 the year to get this done. And if you need some help kind of getting things coordinated or starting off or getting this taken care of, happy to help coordinate this for you, right? So make sure, look at your beneficiary designations, get your estate plan put in place. And younger investors, I know that Lance and I talk about this a lot, but make sure that you're maintaining and preserving your emergency fund. Make sure you're keeping a good 3 to 6 months at least of money set aside in your savings account, emergency fund, because you never know when that unforeseen car repair, whatever it is that life throws at you. You just want to make sure that you have liquidity on hand, so that way you don't have to perhaps raise cash by selling investments at an inopportune time, right? So just always make sure to have that emergency fund set aside. Sounds so basic and so simple, but like Lance mentioned, the stats show that not a lot of people have even $500 set aside in savings. Think about that. Go get a new set of tires for your vehicle. It costs much more than that. So just make sure that you're getting some of those basics, heading off to the right start in 2026. All right.
And one last thing, I guess, to just kind of wrap things up, and this is also a really good time of the year to sit down, get all your credit card statements out, all your debt statements out, all the bills that you're paying, and just review, first of all, review where all your money is going to, right? Because again, in today's society, we have subscriptions for everything, whether it's online subscriptions to a website or to Substack or to newspapers, whatever it is, and you've got 14 different subscriptions to different cable channels, whatever. We're getting subscription death, right? I mean, we're just getting overwhelmed with these subscriptions that we're paying, and they kind of just fall into the midst, right? Because they're just hitting our account at kind of odd places over the course of the month, and this is part of that money leakage that John and I talk about. One thing that we talk about creating cash flow and being able to save. Well, this is the part of the budgeting side, is to try to stop some of that leakage. And so this is a really good time of the year. Review all the things that you're paying for, and look at things like, how long have you been a customer of this particular company? Because again, a really good thing is, like, if you have like Comcast Cable as an example, or Xfinity, right? If you've been a longtime customer of them, you can negotiate loyalty discounts. So all you do is call them up and say, hey, I'm thinking about canceling my service, and they'll immediately give you a discount to keep you on. And you have to do this like every year, but they'll give you discounts to keep you as a subscriber. If you don't do that, they'll just keep tacking on stuff to your account. And so, it's important, and your phone bill is the same way. If you've been a longtime customer of Verizon or whoever, call them up and say, hey, I'm thinking about changing. They'll give you a discount. And these are fairly easy things to do, but it requires a little bit of time and effort. But this is a good time of the year to kind of go through those things and really review all those subscriptions that you have. Are you really using them? I mean, if you're watching Hulu once a year, maybe unsubscribe from it. And then if there's something that comes onto Hulu you really want to watch, subscribe to it and then cancel it again. A lot of times you get free subscriptions doing that way too. But I'm just saying, pay attention to where your money's going, because it's a lot of these things. And again, I've talked about before. In my younger days, I used to build health and fitness facilities, and the great thing about the health and fitness business is that at the beginning of the year, everybody signs up. Everybody's going to go work out, right? They got the New Year's resolution. I'm going to go do this year. And then they don't show up, but that bill keeps hitting the credit card account. That's why you can't walk into the gym. You can't pay with cash or write a check. They put it on a credit card. So they're going to bill you every month because they know you're not going to show up, and you're going to be, and when the bill hits, you're like, yeah, I'm going to start going next month. So, and then you don't go. That's the scam, right, that you need to be aware of, is these kind of revolving memberships. They know that you're not going to use this all the time, and they know they're going to keep billing you even though you're not using the service. So this is a really good time to have a self-assessment of all the things you're paying for and go, am I really going to use that or not? And if you're not going to use it, cut it off and use that and put that money into your investments or savings or wealth building strategies and make it work for you instead of just wasting it.
As you're going through and looking at your financial checkup, pull your, like Lance was mentioning, pull your credit. Go to annualcreditreport.com. You can pull your credit reports there free every year, right? And there's 3 credit reporting agencies: Equifax, Experian, and TransUnion. When you pull those reports, you don't have to pull one for all 3 at the same time. You can kind of space these out. We touched on this in a previous show, but I think it's worthwhile mentioning again. Like, as you get into the first 4 months of next year, pull your credit report from Equifax, right? Check your credit after the first 4 months. Then pull your second report from Experian. Look at your credit, monitor your credit. Is there anything on there that shouldn't be? And then for the last 4 months of the year, pull your credit report from TransUnion. So there is a easy way and a free way where you can access and monitor your credit all year long, just to make sure that just make sure nobody's out there trying to take advantage of you, right? So annualcreditreport.com, add that to your list. Set some time aside, as Lance was mentioning, set some time aside for yourself as you get into 2026. Really educate yourself on your investment options in your 401k plan, the estate planning, everything that I was talking about, but also make sure you check your credit.
That's right. So, all right, a couple things just to kind of wrap up the show today. Make sure that you have go by the website, realinvestmentadvice.com. Make sure you've got your ticket for the upcoming investment summit that's coming up in January. It's January 17th. It's on a Saturday. Now, the Friday night before, we're going to have a mixer with all the speakers. We have Brian Dunlap from BlackRock to talk about artificial intelligence. We got Daniel Kang to talk about the future of stable coins and cryptocurrency. Ed Slott, who's considered to be America's financial planner, to talk about financial planning. Of course, I'll be there. Michael Leibowitz, Adam Taggart. It's going to be a really good day. Lots of information covering markets, investing, bonds, artificial intelligence, cryptocurrency, financial planning, lots of topics, really information-packed. So again, get your ticket now. Ticket sales are doing very, very well. We're well ahead of schedule right now for selling out the event. So make sure you get by the website, get your ticket. If you want to come to the event the night before, I'd love to see you. We're going to just spend a little while having some heavy hors d'oeuvres and visiting with everybody. And of course, you'll have time to talk to us also on the Saturday after the event as well. So we're going to have time to mix and mingle and talk with people. It's going to be a lot of fun, but get your ticket now. Those tickets are on sale at realinvestmentadvice.com. There's a banner right at the top of the page. And of course, we'd certainly love to see you there. Also, make sure that you're subscribed while you're there on the website. Just scroll down a little bit to our market and research section and subscribe to our daily market commentary, our blogs, and our newsletter. The newsletter is the most important thing that we write every week. I've been hitting this a lot lately because I've been doing a lot of work over the course of the last few weeks of the year to start, kind of getting you ready for 2026 in terms of outlooks for different asset classes, those type of things, talking about valuations, what next year may look like in terms of those valuations. So all that works in the newsletter, along with all of our technical analysis, our risk range reports, our technical gauges, our fear-greed indexes. All that is in the weekly newsletter. So get subscribed at the website, realinvestmentadvice.com. Any final closing words?
I would just say if you're looking for help, or if this just all seems just very overwhelming to you and you really kind of don't know where to start, hey, find a fiduciary that you can work with, that you can ask some questions, right? Fiduciary just means that they will always put your interest ahead of their own. That's pretty important, right? So that F word, take it pretty seriously, right? But if you need help kind of starting to sorting, I can't talk this morning, I need more coffee. If you just need help, hey, reach out to us. That's what we're here for, right? So if it just seems very overwhelming, I get it. Like the financial services industry, in my opinion, I think they try to make things more complicated than what they really need to be. This can be very straightforward, very simple, and if you don't know where to start, reach out. We're here to help.
Absolutely. And Merriam-Webster's word of the day, or word of the year, sorry, is slop, which is digital content of low quality that is produced usually in quantity by means of artificial intelligence. So that is now the new definition of the word slop, and it's now taking the pole position for Merriam-Webster this year.
Can you dip slop in chocolate?
I think you can. I think you can pretty much cover anything in chocolate. So.
It is. We cover that slop
And
in chocolate.
whatever you cover in chocolate certainly makes it better. So
There it
there's
is.
no doubt about that. All right, thank y'all very much. We'll see y'all back here tomorrow for the Wednesday edition of the Real Investment Show. We'll do some live Q&A with you tomorrow, talking about markets, money, investing, whatever you want to cover. So live Q&A tomorrow on Wednesday's edition of the show, and of course Thursday with Michael Leibowitz. So a lot of stuff coming up this week. Y'all have a great day. We'll see you back here tomorrow.